on Stocks, and this morning we're excited to present to you Mr. Haroon Cheema. He is a very experienced attorney doing some complicated legal work with dealing with cross-border taxation, which is a very complex area of law, but uh, super fascinated by your experience and expertise. So very glad to have you on the show. Welcome, Haroon.
Thank you. It's great to be here. Thank you very much, Chihiro, for the invitation.
Yeah. So I know I got to meet you through Pedro, and you came to one of our in-person events in Allen, Texas. But I could tell instantly when I talked to you that I was like, okay, this guy has done some complex legal work, and so I'm very excited to have you on. So tell us a little bit about you, like before you were an attorney, tell us about Haroon the person.
Sure. Again, my name is Haroon Cheema. I was born and raised in suburban New Jersey, just west of Manhattan, although I'm currently based just outside Dallas. I realized at a fairly young age that law school was probably going to be for me rather than med school. I had, I'd say, typical or atypical immigrant parents that said you can be whatever you want when you grow up, as long as it's a doctor or a lawyer. I was better at English and history than math and science, so it looked like it was going to be law school. So I went to college at Williams College in Massachusetts, and immediately thereafter went to law school to Georgetown in Washington, D.C. And then I took the bar exams, New Jersey, New York bar exams. And 5 days later, I moved to Houston, Texas, where I began my career with what is now PwC. Back then, it was called Coopers and Lybrand. And I joined a public accounting firm rather than a law firm because at the time, I harbored interests of going to business school, and I'd been told to get an MBA, and I'd been told that a good place to get work experience to apply to business school was at a public accounting firm rather than a law firm because you'll be working with on a lot of quantitative issues as well. Never went to business school, but went on perhaps a wilder ride. A couple years after I left PwC, after about 2 years, and went to a company called in Houston called Halliburton, and I
I've
was
heard of
in
them.
with yep Halliburton in Houston for just a couple months. They dispatched me to Dubai, where they had a regional office. Ostensibly, I was there for 6 months to help with a transition, but I ended up being there for 3 years. I worked on a variety of tax matters in the region, in the Middle East, Central Asia, and South Asia. I was there notably on September 11th, 2001, and had some very, very interesting projects in the aftermath of all that. I was left Halliburton in mid 2002, returned to New Jersey, and began working for Merck, the big drug company up in New Jersey, where I was in the international tax group. Did a lot of compliance and tax operations and a lot of tax planning. I was typically the guy who traveled, so I went to Far East, Central America, Canada, Europe as well, and traveled all over. Still harbored interest in the Middle East. I'd made some friends when I was with Halliburton in Dubai, and then typically go there on vacation every winter to get 2 weeks of warmth. So after about a dozen years at Merck doing international tax work, I went back to the Middle East and became the head of taxation for a sovereign wealth fund, which is a big government-owned investment fund when they're in Dubai, and in the UAE when they've got money left over from building the tallest building in the world and the artificial islands and the indoor ski slope and all these other things, Ferrari World. They invest it in funds, diversified funds, to make sure that the economy is not so much oil-based. So I was the head of taxation there. The fund was called the Abu Dhabi Investment Council. Ran the tax function, built the tax function over about 2 years, and then returned to New Jersey. My father, who was a surgeon, was about to retire. My brother, who lived on the West Coast, had just had his first child. I was 9,000 miles away going, I'm very hot. What am I doing here? So I came back to New Jersey and took some time off. This was late 16, took some time off, and then came to the realization that I've been the head of tax for a large, I've been the head of tax for a very large fund. There is no such position as executive head of tax or senior head of tax or super head of tax. What do I do with myself? Not ready to retire, plenty of ambition left, and still want to accomplish things. So I decided to leverage my legal qualifications, my financial experience, and my international experience, and do something a little bit more entrepreneurial. So I set up a consulting shop. That's Timpani Global LLC. You'll see that in my emails, on my LinkedIn profile, everywhere. So that is a consulting shop where I advise small, mid-sized, large companies on a variety of tax matters, typically cross-border tax matters, but also advise on legal and financial matters. Again, tax is ubiquitous. It's pretty much tax consequences to any exchange of value, whether it's between individuals or companies or across borders. So I've seen a lot of transactions. So I've helped out a variety of businesses with both tax planning, tax compliance, and then more general legal and financial administrative matters. I've had a good time. I was in New Jersey and then COVID came. I was living in my house and decided that if everything is going to video conference, I might as well be warmer and not pay state income tax. So I picked up and moved to Texas. So it's good to be here. My journey has been quite something from New Jersey to Massachusetts to DC to Texas to Dubai to New Jersey to Abu Dhabi, and now back to Texas. And it's good to be here.
Got it. Got it. Welcome back to Texas. Now, one question. During your Halliburton days, did you ever meet former Vice President Dick Cheney, who just passed away days ago?
Yes, I unfortunately I did not. I will spare you. I had access to some of the legal files over in Dubai, and so no, I did not meet him personally, but I was aware. Let's just say I was aware of a lot of the work he did locally before I joined. But I never. Trying to think. No, never had a chance to meet him. I think there was a trip that was scheduled for him to come over to Dubai to the office, and for let's just call it security reasons, that was canceled. But
Got it.
but yeah, never had the chance. Although I've met some very interesting people with, I would say, less public profiles in my career.
Got it. When it comes to international taxation, I know 1,000th of 1% of what you know. But one thing that I am familiar with is, say, you are a Mexican investor interested in investing in something in the United States. That tax situation is completely different from a Canadian investor or Japanese investor, what have you. And it's been explained to me that that is due to different tax treaties being in place between Mexico and the US and so on. So, as somebody who specializes in that as a consultant, let's say uh, you have a prospective client who's from a country that you haven't really done work with tax wise. How does that process work for you? Like, okay, never had a Kenyan client, but now you're a Kenyan person talking to me. How can, how am I going to try to help you now? Like, how does that work?
Sure. So I typically will look at three types of law. First is U.S. law. Um, you know, the U.S. law for inbound investment or non-U.S. Residents or citizens who are investing to the United States. So you've got your domestic U.S. law, which is again federal law and also some state and local law, depending on which state the investment is running through. Two, there's the home country law. In this instance, it would be the Kenyan law. So what I would do is go online and look up what happens for a Kenyan national who receives non-Kenyan income or non-Kenyan gain, and see how that is treated for local tax purposes. And then the third bit of law, and these all overlap and these all apply simultaneously, is if there is a U.S.-Kenyan tax treaty. The U.S. has tax treaties with several dozen countries around the world. It really depends. And I would see if there's a U.S.-Kenya tax treaty that typically will override both Kenyan domestic and U.S. domestic law, and it's typically done to provide tax benefits, to say lower withholding rates, easier information sharing, and things like that. So yeah, when I see a cross-border, whether it's inbound or outbound, so perhaps you have a U.S. investor investing in Kenya, these are the three bits of law I will look at: U.S. law, the non-U.S. countries law, and then an applicable tax treaty.
Got it. So that's the process there. Now that does sound like a very in-depth process, I would imagine. That's going to take some time.
Yeah, it does take some time. It is also a chore if the other country, the counterparty country's language is not typically English. Then you have
Oh,
to
yeah.
do, yeah, if it's Japanese, for instance, or Spanish. From a treaty perspective, there are typically official, formal U.S. translations. But looking into the foreign country's domestic law, it is. I have to find a translation, and then certainly my advice will be qualified, saying this is, my advice is based on a translated, translated legal terms rather than the in the native language. So there is some caution there, but yes, it is pretty in depth. Although certainly I know I've learned which questions to ask. I may not have the answers, but at least I can start with, okay, these are the basic questions or the things I need to find out.
Got it. Now that seems like an area where AI could potentially greatly facilitate people like you in doing this type of work. Is that the case?
It could be. I have read, and maybe you and some of the listeners have read about, the hallucinations in
Right.
legal briefs and other sorts of legal analysis. So I am typically cautious about, throwing something into a GPT for a couple of reasons. One is the hallucinations, that the analysis will just rely on regulations or case law that simply doesn't exist. The other issue, my other caution with using AI or machine learning, is how the information that I input is disseminated, or if it's disseminated. Does it go out onto the World Wide Web? As you can imagine, virtually all of my work is privileged, confidential, private, sensitive. So I am typically wary about, okay, here's the internet, here's ChatGPT, let me type in some very, very specific information to see if I can get a very specific answer. So I'm typically wary of that. What I do use technology for is to find primary sources. So what does, what is the Kenyan text of the regulations for non-Kenyan income earned by Kenyan companies or Kenyan individuals? Is there a treaty? And what I'll do is, okay, so it'll get me the primary sources, and then it will get me, its AI will get me its sources of analysis. Well, there was this law review article, there was this journal article, there was this newspaper article, and I will go and I will read those articles. It's a good way to, have, I would say, uncover or identify source materials. But I do not use at this point AI for legal analysis. I'm just,
That makes sense.
yeah,
Totally
just
makes
not
sense.
going to do it.
All right, so let's jump a little bit into transactional work because that's where you have significant experience. So, can you talk to us a little bit about structuring a transaction? Um, uh, of course, from a buyer and seller standpoint, but principally focusing on our audience, which is limited partners, so LPs who are potentially considering investing into some sort of an acquisition as a limited partner in that deal. What are some of the things to for them to think about with respect to structuring that deal?
Sure. The big one is, whether the transaction is going to be a stock transaction or an asset transaction. Are you buying the company's stock, or are you going, going one level deeper and buying individual assets in a company? For LPs and even for the GP, you're typically going to favor an asset transaction for a couple of different reasons. From a tax perspective, if you're acquiring an asset for a particular price, you can typically, and it's a business asset, you can typically get a step up in basis. So the value will be what you paid for it, and then you'll be able to, with certain exceptions, depreciate or amortize that asset. So that will lead to a tax deduction for the investing company that will be passed through to its investors. So you're typically going to want, as a LP investor, you would want to have a deal structured as an asset transaction. From a, I would say, more general legal perspective, you would want it structured as an asset transaction because you can just buy the assets. You don't need to buy the liabilities. If you buy the stock of a company, you're buying everything. Assets, liabilities, goodness knows what else might be hidden out there. So if you just buy the assets, you can leave the liabilities behind, whether they're, for instance, labor issues or pension issues or environmental issues or tax issues. You leave the liabilities behind and you just buy the stuff you want. And then again, because of the step up in tax basis, you'll be able to depreciate or amortize most of the assets, which will lead to tax deductions. Now, certainly that will be for the acquiring entity, but if you're an LP investing through a partnership is a pass-through for tax purposes. It is not, the partnership itself is not taxed. The income and expense flows from the acquired company through the partnership to the individual investors. So to the extent that the operating company has income, an LP will have a proportionate share of income. Again, this is US tax rules, so subject to a whole bunch of exceptions, but that's typically the way it works. As an LP, you would probably want an asset transaction. So, and then another that's pretty much how you would want. You would say to, if you're investing into a fund, you would say to the fund operator, fund manager, the GP, how are you structuring this? That would probably be the first question I would ask. How are you structuring this as a stock or asset transaction? I want to make sure that I can maximize depreciation, amortization, and make sure that I'm not proportionally on the hook for any liabilities, tax or otherwise.
Got it. Now, I'm pretty familiar with LLCs, both as an investor, as an LP, as well as an issuer, as a general partner in deals. How does an LLC as an entity differ from an LP or a limited partnership?
Not so much. An LLC is a very, very flexible type of entity. You can have a single member LLC, you can have a multi-member LLC. Without digging too deep into the details, one significant difference between a limited partnership and an LLC is the treatment of recourse debt and who's going to be, whether the partners or in an LLC, the owners are called members. They're not called shareholders or stockholders or partners, they're called members. But one highly technical difference between a limited partnership and an LLC is the treatment of certain types of recourse debt. Other than that, the LLC operating model is fairly flexible. It is also relatively new. LLCs became widespread about 30 years ago, whereas limited partnerships have been around for many, many more decades. They are typically, limited partnerships are typically favored in fund structures. You have a general partner that manages the investment or manages the investment fund, and then you have limited partners who are passive investors. But from a tax perspective, they are almost identical. They are both pass-through entities for tax purposes by default.
Got it. Okay. All right. And so we've talked about structuring a deal and what is going to be, generally speaking, ideal or recommended, I suppose, for structuring a transaction. How about financing it? What are some things that potential limited partner evaluating a deal should keep an eye out for with respect to the financing of a deal?
Sure. For a limited partner, the big question, or for me, a threshold question, is this going to be all cash, partial cash? How is this going to be funded? If you're going to put in all cash, that will be your basis in the partnership, and that's the end of it. A capital contribution or a partnership contribution is not a taxable transaction. You're just providing funds, providing capital in exchange for an ownership interest in a partnership. So there's no tax attribute to that. However, if you were to finance the investment partially through debt, those interest deductions, subject to all sorts of limitations, might be tax deductible. So you would take a tax deduction as an for interest expense associated with this business investment. It's a little bit like mortgage interest that is deductible. So if you're an LP and thinking about how you want to invest, it's okay. Do I want to use again, the mix of debt and equity, or should there be equity? And then what the mix is, there are thin capitalization rules that say, well, if you're just going to use all debt, you may not be able to, deduct all of the interest expense. And then if there are other tax-advantaged ways to invest in a company where the returns or the returns from the investment may be tax benefited, tax exempt, depending on how it's structured or what the investing entity might be.
Got it. So to clarify for our audience, what you're saying is if there's debt financing in a deal, there may be a tax deduction for the interest payments on that debt, but those payments are being made by the general partner, the team running the deal, and then those tax benefits then, assuming the deal is structured in a typical manner, that would in a prorated way flow through to each of the limited partners in the deal, and then they could benefit from those tax deductions, right?
Yeah, they could, absent, and again, it's U.S. tax law. The weeds grow pretty quickly, absent special allocations in the partnership agreement and
Right.
passive loss limitations and all
Right.
sorts of other things associated with that. But I would just say, as a general matter, if there is debt being used, there may be a benefit to the investors to that.
And that comment right there, that caveat, perfectly encapsulates why you have a job or why attorneys have jobs, because it's not black and white. And so that's why you and I use words like it may confer some sort of tax benefit to you, but it's subject to these limitations and this and that and the other. And it's very much necessary for somebody with your kind of specialization to tell me, okay, well, in this case, you're not going to get the full 8%, you're going to get 6%, and here's why.
Right. Absolutely. This is why, for any deal that is even, marginally complex, you probably want to engage a tax professional, whether that's a tax lawyer like me or a tax accountant, to get some advice. It gets very complicated very, very quickly, not only from, the pitfall of this, some unintended negative consequences of, if you've misstructured a deal or you've not, filed a form or whatever that might be, and all of a sudden you're not getting the deductions you want, or you're not getting all the income you want, or the tax rate is too high, you're being taxed at ordinary rates rather than capital gain rates. But there are also incentives that may be available through an investment, whether particularly from the portfolio company or the operating company perspective, that could also flow through to some of the LPs as well, whether it's on a state and local or a federal level. So again, this is why you need to, engage someone with this. Is to standard stuff that I've been doing. It keeps me in business. It pays the rent. Is to identify the risks and mitigate them, and identify opportunities and seize them from a tax perspective. And they're out there. It is a rare transaction that is just plain vanilla. There's always something going on, one way or the other, where there may be some incremental tax benefits to be had. And so it's worth doing the due diligence. And certainly there are traps for the unwary. Even if you do have a plain vanilla transaction, if the acquiring company, if the target company has been audited by the IRS or is under audit by the IRS, from my perspective, that is a significant red flag, no matter where, how good or how strong the underlying business is. That is one of those things that when I've been asked to evaluate acquisitions, that's one of the first things I ask. I'll ask for the tax returns. I'll ask for some corporate documents about the type of entity this is and where it was incorporated, Delaware or Texas or Wyoming or New York or wherever else. And then I will always ask, has this company ever been audited, either at the federal level or at the state level, and what's it for? Was it for sales tax? Was it for income tax? Was it for payroll tax? These things matter to me.
Yeah, absolutely. So that brings us to our next topic, which is due diligence. So within that, let's say a subtopic like entity structures, does it matter, or would it, or should it matter to a limited partner in the deal, what in terms of what kind of entity the seller has set up, and then what kind of entity is going to be buying that transaction, and hence I'm going to be investing into as a limited partner.
Sure. You want to make sure one of the quirky rules, and I've learned this one the hard way, is that a multi-member LLC, if you've set up, if you're investing instead of through an LP, you're investing through an LLC, but a multi-member LLC cannot buy an S corporation. So there are two main types of corporations. These are the things that are publicly traded. These are typically big companies, or even small companies, but they're typically set up as corporations, stock companies. There's a C corporation, which has got two levels of taxation, one at the company level, and then when the C corporation pays dividends, the shareholders of that company will also be taxable on the dividend income. Again, subject to all sorts of adjustments. And then an S corporation is typically used for much smaller companies where they can only have a limited number of owners and can only engage in certain types of activities. You cannot have, for instance, a publicly traded S corporation. A C corporation, pretty much every traded company on any exchange in the United States is a C corporation. And then you also have pass-through. So maybe you're investing in an LLC. Again, a C corporation pays tax. But an S corporation, an LLC, and an limited partnership do not pay taxes themselves. They are not taxable entities. It is their owners, whether it's their partners, their shareholders for an S corp, or their members for an LLC that pay tax. One of the things you do want to avoid if you're an LP or interested in making an LP investment is making sure that the structure down below for the investing company and then the target is structured in a way that there's not these multiple levels of taxation. You want the tax attributes and the taxable and the income, the taxable income to flow up as much as you can, so that you don't have these sort of dividend taxes or anything like that. So typically, what you're looking for is you don't want to have this hierarchy or tiered C corporation structure, because then that'll just lead to multiple levels of taxation as it gets up to you, the investor.
Got it. Got it. Now, what are some things that somebody should look for post-transaction? So, for example, my firm, we are undergoing a transaction right now, set to close mid next month. Like, what would somebody considering an investment with us, what should they be looking for post-close or post-transaction?
Sure. One of the big questions is this investment going to generate regular income, operating income, or is it a buy and hold and it will generate capital gains sort of on the back end? That's probably a threshold consideration, because that will depend, if on offsets. Certainly, capital gains are taxed at a lower rate typically, and then ordinary income is taxed at a higher rate. So an investor would say, all right, so what kind of income am I going to be receiving, and how is that going to be taxed? Income or expense? Ordinary income or capital gains? Another question, if I were an LP, I would be asking, would be, what sort of tax incentives are available? You're investing in this company, a local company. Is there any R&D? Because there are both super deductions and tax credits available for that. Is it building anything? It would be a property tax abatement be available. Does it have employees? What kind of employees does it have? Is it doing any hiring? Because there may be payroll tax benefits associated with hiring and training employees. As well. So I'd be looking at, again, are there incentives out there that could either boost tax deductions or increase tax credits? And again, these are just regular questions to ask. Certainly you, Chihiro, or your firm as the general partner should be asking these questions as a matter of course. But again, it is worthwhile for an LP to also ask these questions to say, okay, so how is this going to affect me? What is this going to do with my tax returns? My guess is most of your investors have a variety of investments. It's not going to be their only one, and there will be all sorts of offsets, gains and losses, passive, active income, to manage, to minimize an LP's overall tax liability. So that's one thing. Another issue is, again, this is mostly for me, having built and run tax functions, is what's going on in the tax function at this company. Is it complying? Is it paying its taxes on time? Is it filing its taxes on time? Does it have, again, is there a compliance calendar? Another thing is, have they established policies and processes for preparation and review of tax matters? And this is not only just tax, but also general corporate compliance, administrative compliance, whether it's general legal or HR or finance or anything like that. One of the things, again, from a tax perspective, I started with was, okay, let's put together a compliance calendar. What needs to be filed or paid, every twice a month or every quarter or every year. And then it became, okay, so we need some internal processes here to make sure that whoever's preparing a calculation or a filing or a payment is not the one approving it. So you need to have a separation of preparation and approval, whether it's even two people or three people or multiple levels of review, review, approve, sign, stuff like that. Again, these are standard for me tax due diligence questions. If I were an LP, and again, being a tax professional, these are questions I would ask. What is your compliance like? And then from a tax planning perspective, and this circles back to the, okay, is this going to be ordinary income versus capital gains, is where is the value in the company? What differentiates this company from its competitors? Where is the premium going to be earned? And that will also dictate whether the income is going to be ordinary or cap gain. I worked in big pharma for about a dozen years, and it was absolutely clear that the value generator was the patents. Otherwise we would be a generic drug company with low margins. So once you have identified where the value is in a particular investment, from a tax perspective, what you want to do is make sure that, and gets back to a lot of my cross-border work, is that value, those returns on that differentiating value, that premium value, are subject to as low a tax burden as possible. And a lot of that, particularly working in pharma and in energy, was moving certain assets to low tax jurisdictions, whether it was Ireland or Switzerland or the Netherlands or Luxembourg or Singapore or Hong Kong. Historically, the US corporate tax rate was in the mid-30s. It's now down to 21%. So you could get a good tax rate arbitrage by moving things, for instance, to Ireland. Tax rate was 12.5%. And a lot of countries, Switzerland, Singapore, the Netherlands, would offer tax incentives where you could get, mid-teens, even single-digit tax rates. So that's one thing as an LP I would be asking: where's the value? What sort of returns does this value generate, ordinary income or capital gains? And what is the company doing to maximize the after-tax return on this value?
I have a question about pharma. With that being such a heavy R&D intensive industry, does that confer any tax benefits when you're devoting so much cash to research and development?
Certainly. There are two provisions in the code, not get too much into the weeds. There's the Section 41 R&D tax credit in the US code that basically says that for certain money you spend on R&D. So let's say if you're in big pharma, you're going to spend $5 billion on R&D. And you go through a calculation, and it turns out on an effective basis, the R&D tax credit is worth, let's call it 10% of your R&D spend. So what would happen is your tax bill would decrease by $500 million. You get a tax credit for your R&D spend. There's also a provision 179, which is a super deduction for certain R&D activities that basically says, okay, not only can we get a tax credit for these activities, but we can deduct the cost of these activities immediately. We do not need to depreciate or amortize these costs. Otherwise, for certain activities and certain assets related to this, you'd have a 5, 7, 8, 15-year depreciation cycle. And one of the things that happened with this one big beautiful bill, whatever it's called, that happened in July is um, the country has reestablished expensing for R&D costs. So now, if you incur $5 billion in R&D a particular year, you can, and again, qualified R&D, you can deduct that $5 billion on the company's tax return. So you will get a $5 billion deduction and a $500 million tax credit. So these are sort of the incentives. Particularly, there's also manufacturing tax credits. There were certainly under the Biden administration a lot of clean energy tax credits for solar, battery, carbon capture, things like that. So there are a variety of tax credits that are out there. I mean, probably the best one is the R&D tax credit, which has been around for many decades and is pretty much here to stay. And then there are all sorts of super deductions. One thing to keep in mind, and again, not to get so much into the weeds, but there's a difference between a tax deduction and a tax credit.
Yes.
A tax deduction lowers your taxable income, so it is a subtraction from your taxable income, and will lower your net taxable income. A tax credit is a dollar for dollar reduction in your tax liability. So if you've got a 21% tax rate and you've got 100 of revenue and 80 of expense, you've got $20 in taxable income. If you get a super deduction that makes your expenses 85, you will have $15 of taxable income. And then if you get a tax credit of, let's say, 3, you'll have taxable income of 15, subject to a 21% tax, which is about $3.2 in tax. And if you have a $2 tax credit, you'll pay $1.2 in tax. So there's a difference between a tax credit and a tax deduction. And it's probably good if you're an LP to make sure that you keep, whoever's the investment manager honest about calculating tax credits and tax deductions.
Yeah. So bottom line, a tax credit generally, maybe certainly, is more valuable to you.
Oh, yes.
Than a tax deduction. Yeah.
Certainly. Although, again, it always depends, because if you've got losses and you've got a tax credit, you need to be able to, you can typically carry them back for a year and then you can carry them forward. But yes, a tax credit is generally more valuable than a tax deduction.
Now, here's a question again from a limited partner investor standpoint. When I learned years ago about the tax benefits generated by investing in certain types of oil and gas deals where they're actually physically drilling, I think it's called intangible drilling costs or something to that effect. That is extremely valuable because it offsets your ordinary income regardless of how you generate that ordinary income. And me being a commercial real estate investor, I thought, wow, that is incredible as far as the tax benefit is concerned. Are there any other similarly tax advantaged investments in the private offerings world that offer those types of benefits?
The one I am most familiar with, and it was, going great until the middle of the summer, was clean energy investments. Again, through the Inflation Reduction Act, there were a whole host of credits that were offered, and the way the credits were calculated, where you could get almost 70% of project costs in tax credits. And not only could you get these tax credits, even if you couldn't use these tax credits, because a lot of these were smaller companies, they don't have huge margins, they don't have huge amounts of revenue, they're incurring costs, it's infrastructure investment. You could sell these credits to a third party for cash, subject to a discount. But the one that comes to mind first is are going to be clean energy tax credits. There are also, again, it really depends. The other moving piece to this is tax law changes every day.
Yeah.
Whether it's in the U.S. or elsewhere, I get up in the morning and that the first thing I do is get my coffee and read the tax news. I subscribe to newsletters that tell me, in this country this change, and in this country this change, and in this state the tax law change. So it is a moving target. There are, again, depending on the industry, a whole host of benefits. It used to be clean energy. I know with the Trump administration's attitude towards drill, baby, drill, they have maybe not introduced incentives, but loosened restrictions or made certain costs more deductible before than they were before under the Biden and previous administrations. But depending on the industry, my guess is based on the news, there may be some upcoming regulations about pharmaceuticals, life science to get healthcare costs down as well. There may be, and this is on the federal level, there may be state incentives. Well, if you invest in this location, we'll give you a property tax abatement. Or if you're selling, you set up your store or shop in this particular area, we're going to give you a sales tax reduction and you're selling to the public. Or if you train these number of people, it's something I touched on before, we'll provide you credits for training and for hiring, and you'll have to pay less employer withholding taxes. So it really depends. There are federal incentives, which probably get the most attention, but you've got state and sometimes local incentives that may give you the biggest bang for the buck. A lot of the state incentives can be negotiated. You go to the state tax authority and say, look, we're going to do this, have this activity, that activity. We want a property tax abatement. We would like a state income tax abatement. We would like these tax credits for making all of these investments. On the federal level, there's no real such negotiation possible, but certainly on a state, particularly if you're investing in a location or a part of the state that is looking for development, yes, those sorts of incentives may be available.
Yeah, absolutely. I mean, we read about that all the time in sports stadium construction
Yep.
projects. They get
Yeah.
abatements. So, but the project does not have to be that large to get those types of abatements. I've
Yes.
seen those come across my email inbox frequently on an apartment development deal or something to that effect. So,
Yes.
well, amazing feedback and knowledge that you dropped on us today, Haroon. So thank you very much. Is there do you have social media or your website that you would like to share with our listeners if they want to learn more about you?
Sure. I am on, helpfully, like Chihiro. My name is not terribly common, not like Joe Smith or Bob Jones, but certainly you can find me easily on LinkedIn, Haroon Cheema. The name of my company is Timpani Global LLC, timpani like the kettle drums. I'm actually a classically trained percussionist. When MTV was ascendant in the 80s and I wanted to rock out, they said, okay, you can play the drums, but you can't play those drums. You're going to be, play the snare drum in the band and you can play in the orchestra. So I became a classically trained percussionist. I've actually had triangle lessons, but you can find me on LinkedIn. My name of the company is Timpani Global, one word. You can find me basically a landing page, timpaniglobal.com. And you can email me if you wish at my first name, Haroon, Haroon, at timpaniglobal.com, timpaniglobal.com. And sure, I'm happy to speak with you, the listeners, about anything. Naturally, as a lawyer, everything is confidential, and happy to chat. Thank
All
you.
right. Thank you, Haroon. All right. Well, Beyond Stocks, thanks everybody for listening, and we'll see you on the next episode.